Two investors, same markets, same era, completely opposite outcomes. The first one held advanced degrees from the most prestigious institutions in the world. His models for pricing financial risk were so sophisticated they earned him a Nobel Prize. He had access to data, computing power, and analytical firepower that most investors could not dream of, and he lost billions, not through some unlikely catastrophe, but through a series of decisions that in hindsight were predictable expressions of very human overconfidence. The second investor had no such technical sophistication. By his own description, he spent considerable time reading, thinking slowly, and doing very little. He bought ordinary businesses, held them for extraordinary lengths of time, and compounded his way to one of the largest fortunes ever assembled. This video is not about intelligence. The smarter man, by almost any conventional measure, lost. This is about 12 specific mistakes that intelligent people make with money. The same 12 that the second investor spent 60 years carefully refusing to make, and that James, a 36-year-old investor who stumbled across a library copy of Buffett's letters 3 years ago, has been slowly working through ever since. Before the 12 mistakes, the single idea connecting all of them. Every mistake on this list is a variation of one core error, trying to be smarter than the market rather than more patient than it. The harder someone works to outwit the market through cleverness, the more they tend to pay for the attempt. Buffett called the essential quality of a successful investor temperament, not intellect. These 12 mistakes are 12 different expressions of forgetting that. Mistake 1. Trying to predict market timing. The appeal of market timing is obvious. Buy before the rise, sell before the fall, and outperform everyone who held through the volatility. The appeal does not survive contact with the data. Buffett admitted in the middle of one of the worst financial crises in modern history that he had no ability to predict short-term market movements. Not that he was temporarily unsure, that he genuinely lacked the capacity to do it, and did not expect anyone else to possess it reliably either. The reason this matters beyond philosophy, the market's gains are concentrated in a handful of days that cluster with cruel predictability near its worst periods. An investor who missed only the 10 best trading days across a 20-year period would end up with roughly half the wealth of someone who held continuously. 7 of those 10 best days typically fall within 2 weeks of the 10 worst days, meaning the investor who fled the worst days was almost certainly absent for the recovery that followed. James sold in early 2020 when his account was falling, and the news was uniformly alarming. He planned to buy back once things stabilized. The stabilization arrived without warning, about a month later, significantly higher than where he had sold. He missed it entirely. The move felt cautious. It cost him years of compounding. Mistake 2. Paying high fees without noticing. There is a number quietly consuming a portion of many investors' returns right now. It does not appear on any monthly statement as a line item. It accumulates silently, year after year, as a percentage of assets, and over decades, it becomes one of the most significant financial decisions a person makes. Buffett made this concrete with a public wager in 2007. He bet that a simple, inexpensive index fund would outperform a selection of sophisticated, actively managed hedge funds over 10 years. The hedge funds had elite managers, advanced algorithms, and access to opportunities unavailable to retail investors. They also charged fees that the index fund did not. Over the decade, the index fund won by a margin that was not close. A 2% annual fee on a $100,000 investment over 30 years does not subtract 2% of your wealth. It removes roughly 43% of your ending balance compared to a zero-fee alternative. The fee is a certainty. The outperformance it is supposed to purchase is a probability that rarely materializes. Never pay a certainty to rent a probability. Mistake 3. letting emotions drive decisions. The average active trader consistently underperforms the average passive holder, not because active traders are uninformed, but because trading frequency generates tax events, transaction costs, and a relentless exposure to the fear and greed cycle that long-term holders simply avoid. James tracked his own trades over 18 months and found he could not identify a single one that had clearly improved his outcomes. The activity felt like management. It produced the costs of management without the benefits. Mistake 4. Overtrading and the hidden tax cost. Every sale of a profitable position in a taxable account is a taxable event. The patient investor who holds a great company for decades never triggers that event. The gains compound untouched for years before any tax is owed. The active trader converts long-term compounding into short-term taxable income repeatedly, handing a portion of each gain to the government on a schedule that dramatically reduces the compounding base. Mistake 5. Investing in things you cannot explain. Buffett built his investment philosophy around what he calls a circle of competence, the bounded set of businesses he genuinely understands well enough to evaluate. He was explicit that the size of this circle is less important than knowing exactly where its edges are. He applied this to himself with uncomfortable honesty. He avoided technology businesses for decades because he genuinely could not evaluate them with confidence. That discipline protected him from the collapse that ended most dot-com era investments. It also meant he watched companies like Amazon and Google become transformational businesses from the sidelines. He has acknowledged missing both. His answer to the trade-off? The money you failed to make on a business you didn't understand was never really yours. The money you lose on a business you misunderstood was. Those are not equivalent costs. James put a meaningful portion of his savings into a company he could not describe in concrete terms beyond the CEO seems visionary. He knew the ticker symbol. He did not know how the company generated revenue, who its primary competitors were, or what scenario would cause the business to fail. That is not an investment. It is a bet wearing investment's clothing. Mistake 6. Anchoring to your purchase price. The price you paid for an investment has zero effect on what that investment will do next. The market does not know what you paid, and it does not adjust its behavior in response to your feelings about the number. When a stock falls significantly below purchase price, many investors interpret this as an opportunity to buy more, averaging down on the assumption that cheap yesterday means value today. Sometimes this is correct. Often, it is a cycle of increasing commitment to a deteriorating situation, where the falling price is accurately reflecting a deteriorating business rather than representing an unjustified discount. Buffett's advice for investors who find themselves in a hole is direct. Stop digging. The only honest question when a position has moved against you is whether you would buy the business at today's price if you did not already own it. If the answer is no, holding it is making the same purchase decision every day, just driven by pride rather than analysis. Mistake 7. Following the crowd. The market's most expensive moments are precisely the moments when the crowd is most convinced something will keep rising. Buffett borrowed from his mentor Ben Graham to make this point. You are not right or wrong because the crowd agrees or disagrees with you. You are right because your reasoning and evidence are sound. The crowd is not a source of analysis. It is a collection of people doing the same emotional thing simultaneously, which is the mechanism that creates bubbles. The crowd gets you into a position. It will never tell you when to leave. The antidote is not contrarianism. Consistently doing the opposite of the crowd is still letting the crowd decide. The antidote is independence, doing your own work and arriving wherever the evidence leads without reference to what the majority believes. Mistake 8. Using leverage. The two men from the opening of this video. The investor with the Nobel Prize was Robert Merton, whose fund, Long-Term Capital Management, used leverage ratios exceeding 20-to-1 on positions that, by their own models, carried minimal risk. When markets moved in ways the models had described as nearly impossible, the leverage turned modest losses into existential losses. The fund lost billions in months. The Federal Reserve organized a rescue to prevent the collapse from spreading. Buffett's observation about this outcome has become one of the most cited sentences differences in financial history. They risked what they had and needed in order to gain what they did not have and did not need. They were already wealthy, already accomplished, already successful. They borrowed to squeeze more return from positions that were already performing. The leverage did not raise their ceiling. It removed their floor. At personal scale, the mechanism is identical. Borrowed money in a falling market generates margin calls, forced selling at the worst possible moment, locking in losses that a patient investor with no leverage could simply wait through. Leverage steals the patient investor's most powerful weapon, the ability to wait. Mistake 9. Confusing price with value. A stock's price is set by millions of people's current emotions and expectations. A stock's value is determined by the cash the underlying business can generate over its remaining life. These two numbers sometimes align. Often they diverge significantly in both directions. Buffett treats a share of stock as a fractional ownership of a real business. When the price of a business he owns falls dramatically, his first question is whether the underlying business has changed. If the business is as strong as he believed when he bought it, a falling price is not a loss. It is an opportunity to buy more of something he already understood and valued at a price the market is temporarily offering below that value. Price is what other people are feeling about a business today. Value is what the business actually is. Investors who track only price will be tossed around by every shift in market sentiment for their entire investing lives. Mistake 10. Selling winners too early. Buffett's stated preferred holding period for great businesses is forever. Not until the investment doubles, not until the gain feels secure. Forever, as long as the business remains fundamentally strong. The compounding mathematics explain why this is rational rather than sentimental. $100,000 growing at 10% annually becomes roughly $450,000 over 30 years and roughly $1.7 million over 50 years. More than half of the total wealth created in that second scenario arrives in the final 15 years. The investor who sells at year 25 because the gains feel adequate has collected the work of the first 25 years and voluntarily surrendered everything the compounding would have produced from that point forward. Buffett generated the large majority of his total wealth after his 60th birthday, not because he became more skilled, but because the compound curve he had been patiently riding for decades finally reached the vertical portion. He did not get rich quickly. He got rich slowly, and then, from certain vantage points, apparently all at once. James held a position for 2 years, watched it rise 50%, decided to take profit, and reinvested in something he was more excited about at the time. The original position has since tripled from where he sold. The replacement never recovered from an early decline. He gave up his best performer to fund a stranger. Mistake 11. Getting diversification wrong in both directions. Buffett has said apparently contradictory things about diversification, and both are true depending on which investor he is addressing. For someone who genuinely does the work, who studies individual businesses deeply, understands their competitive dynamics, and can value them with reasonable confidence, spreading capital across 50 mediocre businesses dilutes the best ideas without adding proportional safety. Buffett himself has run highly concentrated positions in businesses he understood thoroughly. For the vast majority of investors who are not conducting that level of ongoing business analysis, his recommendation is the opposite: a single, low-cost index fund tracking a broad market. He put this in writing in his own estate instructions, directing that the money set aside for his wife should be invested 90% in a low-cost S&P 500 index fund. The mistake is mismatching strategy to knowledge. Concentration without deep understanding produces the risk of concentration without the edge that is supposed to justify it. If you cannot explain in detail why a position deserves a significant portion of your portfolio, the appropriate response is diversification, and a single index fund accomplishes this more thoroughly and at lower cost than any collection of individual picks chosen without equivalent analysis. Mistake 12. Hiding in cash and letting inflation win quietly. This is the mistake that disguises itself most effectively as caution. Cash does not lose value dramatically in any single day. The account balance stays the same. It simply purchases less every year as inflation erodes its real power. Not dramatically, not visibly, but consistently. At 3% annual inflation, money held in cash loses roughly half its purchasing power over 20 years. The number on the statement is unchanged. The actual wealth it represents has been cut in half. Buffett called inflation one of the most devastating taxes that can be imposed on accumulated wealth, not because it announces itself, but precisely because it does not. It's a tax nobody votes for, that appears on no statement, and that operates continuously regardless of what the holder does or does not do. Cash is appropriate for emergency funds, money that needs to be available immediately when something breaks or an income is interrupted. That is wisdom. Long-term wealth held in cash rather than productive assets is not caution. It is a guaranteed real loss, accepted voluntarily. James has made most of these mistakes. He sold in a panic. He paid fees he didn't scrutinize. He bought businesses he could not describe. He averaged down on a deteriorating company because the falling price felt like an opportunity. He sold winners early and replaced them with strangers. What changed was not his intelligence. His intelligence was never the issue. What changed was his attention to which mistakes he was making and his willingness to stop making them one at a time. He held his most recent winner through 2 periods of significant decline. He moved his unexplainable positions into an index fund. He sorted his cash into its appropriate bucket and stopped checking his account daily. None of these are genius moves. They are the removal of self-inflicted obstacles. Buffett's edge was never superior analytical power. It was the consistent refusal to do 12 things that intelligent people find compelling to do. That refusal is available to anyone. The most expensive mistakes in investing have always been the quiet, comfortable, reasonable feeling ones. Now you know all 12 by name.